It's Thursday, December 2nd, 2021. And today we're talking about Constellation Software launches a VC arm, Tiger and Salesforce get a Klue, Spare raises $18 million for its mobility software platform, and the end of the road for Roadmunk. Let's get started. First, Constellation Software launches a VC arm. Alex, can you tell me more about this fund?
So late last week, Constellation Software announced it was launching its first corporate venture capital fund. It has $200 million in funding. It's going to be invested over 3 to 5 years. The fund will be called VMS. Can you guess what that stands for?
No.
Vertical Market Software.
I
And
was
will
going to say
target
virtual market software. I thought it just doesn't make sense for a Constellation.
and it's going to target companies in which managers and employees own a significant stake. So if you've raised like 4 rounds previously, you're probably not the target for this fund.
And that's their model, right? They're going to partner with current management and current
Yes.
ownership to continue to grow.
Well, I think there's two things that explain how Constellation has traditionally worked. They target vertical market software, so call the fund VMS, and they like companies that are, I guess, for vertical are niche specific and are owned basically by the owner operators, so that they have stake in the game and they can buy them out pretty easily.
And why does this all sound so familiar, Alex?
Well, if you go back a few years, there was basically no such thing as a corporate venture capital firm in Canada other than TELUS. I think Intact may have had one, but in the last few months, it seems like every couple of weeks there's a new traditional corporation announcing a corporate venture capital fund. So if you go over the last few months, you got Klue, Thomson Reuters, you got Spin Masters announced funds. If you go back over the last 2 years, there was a few other sort of corporate sort of like venture capital funds announced. One that's never been announced, but company that's been acting like they have a corporate venture capital fund is Shopify, and the Westons and the Marais, who are basically their corporations, even though they're separate entities, have launched venture capital funds. Whittington Capital, and then the Marais has like 6 or 7 entities that invest in venture.
Portage, Diagrams, Sagard, you'd take your pick.
Yeah. So, so this is something that was very common in the States and to a certain sense Europe, but not in Canada now. It seems like I bet every month in 2022 we'll see another corporate venture capital firm.
So it's definitely a trend. What makes Constellation's fund different or more notable from just another Me Too corporate VC arm?
So, first of all, I think most people are familiar with Constellation, but in case people aren't, they're Canada's second largest publicly traded tech company. So you've got this company called Shopify, which I'm sure all our viewers and listeners are familiar with. Then you've got Constellation, which has a market cap of, let's call, $50 billion. And what they are is they're a conglomerate that acquires niche software businesses. What's interesting about this corporate VC firm is they're focused on investing in companies a bit earlier than Constellation would acquire them. So they're saying, hey, maybe we'll want to acquire you. You're vertical, you're niche, you're vertical market specific, and you're basically owned by the owner operator. We'll invest in you. And they're not going to get the benefits of being part of the sort of the conglomerate, so they can be independent, but it almost sounds like a scout fund, for lack of a better word.
Interesting. So now we have in Canada a lot more developed sources of capital for entrepreneurs. If I'm a founder, when do I target talking to a corporate VC arm? And when do I target talking to maybe a more traditional venture capital fund?
Well, I'm going to reshape that question as to which corporate VC fund should I be looking at when I raise? And I think that first understands how corporate VC, you have to understand how corporate VCs are different than traditional VCs. A corporate VC typically has one LP, so one backer, who provides an evergreen fund. So unlike, let's say, Inovia, which probably has 50, 60 LPs and has to go raise every 2 to 3 years, typical corporate VCs have, Constellation's providing $200 million. It is $200 million. It's for finite time, but will probably get renewed on an ongoing basis. They don't have to go to market to raise. The second one is corporate VCs have different goals. Some are looking for strategic investments like this one. Some are looking to grow the parent's company ecosystem like what Shopify does. And some are just looking for pure investments, which is like what you see in Intel or Google. Like Google's VC arm is basically money from Google that go invest in what they want. And then they add value in different ways. Some will help you partner with the parent company. Some will tilt the market in your favor. So like if Shopify, again, nothing anti-monopolist. I mean, and nothing monopolist here. But if Shopify invests in you and you're one of the buy now, pay later, they may promote you a bit more in the marketplace. They may help you understand the marketplace a bit better.
Yeah, distribution. There's all sorts of things that they can help with, right? Expertise. Yeah, I agree.
And some are hands off. So when should you actually go target them? When you're going to raise, you should understand what you want from your investors. You should look at the corporate venture capitalists out there and see if any of them meet your criteria, and then include them in your round. Um, they and you should probably include them just as you would with a normal VC, but but understand how they operate and what their motivations are.
But what should you look out for? Like, what are some of the potential downsides of going that route?
I think some of the downsides is if you get the one where the primary goal is a strategic investment, it may scare off some traditional investors because they may view it as, hey, this corporate VC is going to feed an acquisition to the parent company. Um, and so if they don't invest, it's a bad signal. If they don't buy, and if they buy you, they might buy you too cheaply. Um, you have to understand what's driving the actual investors, not the entities. What's their economic interest? And it may be something that's not obvious, and they'll act in a different way than a traditional VC. And newer ones may not be evergreen, and so they may not be able to follow on with their investments, which is not a huge issue, but could be a pain when you go to raise again. And that actually sometimes happens to newer VCs as well. They don't get the fund 3 or fund 4. So there is some reasons to get them. On the positive side, when they invest, it may act as social proof for other VCs, and you might see the round come together quicker. They help you in ways you said, and they're typically less price sensitive than normal VCs, which may or may not matter in this market. Yeah,
There's a lot of price insensitivity today.
yeah.
So, if you're a TechTO founder, why are you excited or maybe worried about the trend here?
So excited because more funding options are always good for founders. A bit worried because Canadian corporations traditionally haven't had a venture capital fund. I haven't gone back and looked at historical correlations with market tops, but maybe the sign says we're getting near market top.
It's like when all the MBAs want to go into technology, it's near the top. So when all the corporates want to go into VC, we're also getting too close to the edge, huh?
Potentially.
Potentially. I think that's very cool. What about for the early stage founders? Are these corporate VC arms playing in the seed rounds and early rounds? Or are they more of scale up capital for Series A and later?
It depends on the firm, but I traditionally say they'd be like an A round or later, right? Like they unless you are they're strategic and you have a reputation in an industry, I think it's hard for them to go extremely early. Again, it depends on the fund. Like I think Salesforce, which actually has a fund dedicated to Canada, may go earlier.
And we've seen them use that fund as well. Um, is there any place where you can find a list of these latest corporate venture arm announcements?
Not that I know of it. Maybe we should put it on TechTO.
I'm thinking maybe in tomorrow's newsletter, that can be a
What?
place where you can learn about the latest stories and trends, including let's just grab a list of some of them and throw them in the newsletter. What else can the community expect in our upcoming editions?
Well, it's going to be 2022 soon somehow. Um, Part of that, you can expect more in-depth rundowns and trend forecasts for the upcoming year. We also have some exciting event announcements for 2022, and we're gearing up to announce our full events calendar for the new year. So make sure you subscribe, and we're going to help you make your New Year's resolutions possible. You may want to become skinnier, you may want to be more successful, whatever it is. Our newsletter is going to help you do it in 2022.
Whatever your goals, health wise, relationship wise,
Family
tech wise.
wise, yeah. Dating
Yeah,
life.
sure. You can just subscribe to reach all your 2022 goals and get the latest news, trends, advice, and events. You can subscribe at techto.org or on all our social media platforms. Just look for the link in our bio. All right, next, Tiger and Salesforce get a clue. All right, what's the news here, Alex?
So Vancouver-based Klue, which described themselves as an AI-powered competitive enablement platform, that's a mouthful, raised $62 million USD in a Series B funding led by Tiger Global with participation from Salesforce Ventures. And note that Salesforce Ventures, that's not the Canadian corporate VC arm of Salesforce.
Not the one you just mentioned. And so why is this fundraising announcement so interesting to you?
Well, first, usually these announcements, you get this long list of people that participate around. And what it is you have a new lead and you have people taking their pro rata. This one has 2 entities and none of them are previous investors. So looks like Tiger wanted to take, if you read, but what's out there, Tiger wanted to take the entire round, and the current VC said, yeah, fine, we're happy with Tiger taking a round. And then Jason and the Klue team said, well, we want Salesforce to be here for strategic reasons, so let's make some space for them. The other thing is the closest direct competitor recently raised 22 million USD, and Tiger seems to have come a bit over the top to supposedly anoint a winner.
Okay, so a couple questions there. The first is, when your existing investors aren't participating in their pro rata or maybe leading subsequent rounds, is that usually a red flag?
So if you go back 2 years ago, that was a signal, and that was also a reason to take, hey, you don't want to take from a multi-stage fund if they don't come in later rounds. What are they saying about the current round? I think in the current market, there's a lot of people at each round that just don't give a damn about the previous investors and willing to take the whole round themselves. So the signal, in this case, the signal risk is actually not there, because the lead want to take the whole round. Now, if it was someone like, I don't know, I'm not picking any, don't know if this would happen, Inovia, who might not write a $60 million check, and you didn't have the past investors, maybe that'd be a negative signal.
Right. And so there's a second signal here, which is, you mentioned the competitor raised a 20 odd million dollar round, and this is a $60 million odd round. So does that make Klue the category leader now?
Well, Tiger's trying to signal the market that they believe this is the category winner. And I think you could go argue that these resources can help Klue become the category winner, but it may also complicate it and make it hard. But for now, the media will play that Klue's now won this category.
So how does it complicate it exactly?
Well, so look, you get lots of money. What do you have to do with it?
You got to invest it.
And so what are you going to do? So you're going to invest it in, like, I could see Klue, to expand its geographic footprint, to expand its product offerings, the number of customers it goes after,
Yeah,
its
it's got to
sales team.
hire, it's got to go market, it's got to make an
Yeah.
acquisition.
And you know what to do, maybe. But it's hard and tricky to do at the speed ventures want you to do it at. And so there's a lot of error. There's a lot of chance you make errors, and they compound over time without you realizing it, and that you end up actually taking shooting yourself in the foot and have a problem to deal with. Not saying that's going to happen, but for every a category winner doesn't actually happen unless someone's actually deployed the capital right and won it. Now, what you have here, the ability to pay more, the ability to move faster, but that's a blessing and a curse. So it comes back to making the right decisions, executing, and being a bit lucky.
Yeah, that's come back to execution. Got to have all of them, though. I agree. Lucky and making some good decisions. So, what impact is this round going to have on the ecosystem?
Well, more money into this ecosystem, great for founders, great for VCs, and even better for employees.
Yeah.
It's not like they got $60 million and said, okay, here's 50 more experienced engineers in Vancouver or Toronto. It's so I think you're going to see pressure on employee engineer wages continue, and probably BDRs as well. Tiger's aggressive moves is going to continue to force late stage VCs to think about their strategy and how they want to react and how they position themselves in the market. What does that actually mean? I am not 100% sure, because I don't know which players feel that they have to change their strategy and how they will change their strategy.
Yeah, it's an interesting comment that you mentioned about employee benefits here and wages and total compensation rising. I wonder if there's anything to be said for a lot of this money maybe going into nice corporate leases before, and without those corporate leases going right into the pockets of employees.
Well,
Anything that you've seen about that?
So there is, like, look, if you go fully distributed and you give up your office, like, I actually talked to a couple founders that I know well that said, hey, we're giving up our offices, we're giving up those perks, but we're going to they go into different perks and they go into different costs. Like,
Right.
I was talking to someone in Seattle, he has 200 employees. He's going to do an offsite every quarter, which will cost him the same thing as his lease. So
Got it. So it's not necessarily going in; it's just a redistribution.
Yeah.
The losers are the commercial real estate folks, and
and again, I think
winners.
that's presumptuous. I think commercial real estate's not going away. I think you're going to have less density and different use case for commercial real estate.
Okay, that's for another topic. I like it. I like this topic. If you're a TechTO founder, what are you learning from the Klue raise?
First of all, again, we didn't get into this, but there's momentum here. We've talked about nonstop. You got momentum, you can convince people your category leader, you can raise a shit ton of money. Then going back to this employee inflation, salary inflation, if you haven't prepared to raise your employees' salaries for engineers by the end of the year, you might want to check if you're still paying market rate, and if not, adjust, help push inflation higher, or risk losing your employees. And again, it's particularly engineers, less, and then BDRs, and then everyone else who are not as lucky.
Amazing. I love it. Let's talk about what's coming up in the TechTO ecosystem. I'm excited for this. Tomorrow on Founders and Funding, you're going to be sitting down with Brendan Wales, the founding partner at Fuse Venture Partners, and Michael Bignold, the founder and CEO of Cost Certified, for a candid conversation on how their round came together, what Mike wished he knew before raising, and what VCs are looking for in a company. Can you tell us a little bit about that round?
Well, it was a pretty, I think, if I remember correctly, it's the biggest seed round in Alberta history. And
Okay,
it's a
that's a
pretty
pretty
ambitious
good
founder.
hook. An ambitious founder, a big seed round, and that's all going down remote virtually tomorrow on techtio.org. And then on Wednesday, December 8th, that's next week, we are back in Vancouver in real life. We'll be joined by Ian Wong, co-founder and CTO at Opendoor, and Serge Salger, the CEO at Visual Ping. We're going to be talking about the journey to IPO, raising rounds back to back, and building companies from the ground up. Alex, what are you hoping that we ask the founders there in Vancouver on Wednesday?
Tough questions. Oh, you want specific questions?
You can give me a specific one.
I'd ask Serge, what does he think about the current funding environment? Because, he raised a couple quick rounds, but it's been now like 9 months. And does he feel the pressure to raise 9 months in opposed to normal 2 years?
Mm-hmm.
It also asks about again, topics we talked about here. How do you go about recruiting a team when there's so much capital out there?
Yeah, and then come on, there's a big topic hanging out there for Ian. What are you going to ask Ian about?
Going public? I don't know.
That's a good one.
But the parties in his houses when there
Yeah.
are people breaking in for parties. I don't know what's the topic you have in mind. You're trying to get
I
playing
was
fish.
thinking about Zillow pulling out of the programmatic buying program.
Oh, that was like
would be
3 weeks ago. That's like old
okay.
news. I
That
don't even
news
remember.
cycle is over. Okay, I understand.
Who's Zillow?
And always a fun crowd out there. William brings the heat. He brings the noise. He brings the vibe. It's going to be super fun out in Vancouver next Wednesday. All right, next up, Spare raises $18 million for its mobility software platform. Who was in this round, Alex?
So Vancouver-based Spare raised from Inovia, who's the lead, Kensington Capital, Link VC, Ramen VC, Ridge Ventures, TransLink Capital, and Japan Airlines, which apparently is their innovation fund. So there's another corporate VC. Seems to be corporate VC week, and Nicola Wealth. So a bit longer list of investors here.
And what does Spare do?
So they provide a mobility software platform for public transit, ride sharing, and other shared transportation. So if you have a transportation network, they provide basically an operating system designed to make you run your business better.
Okay, so these are big clients, big deals.
Yes and no. What's interesting here is they seem to thrive in smaller municipalities that want to offer where people want mobility services. So it's they may serve a client like Toronto, but it's also like I'm trying to think of a smaller town outside of GTA, like Squamish in BC or Innisfil, that you don't associate them with like big transportation networks, but there's a lot of mobility offerings there, and that's where they seem to be thriving.
Got it. And why was it able to raise this round?
I think they're a company that's in the middle of a few trends that are out there. So one is everyone wants to offer more services to their population. And you saw a lot of people move to these, like call them exurbs or smaller, distributed workforce. You don't have to be in a big city. You move to Collingwood, you move to Squamish. You know, you can see my geography. Small towns across North America, small is not well, but like, and the problem is those people now want to offer more services to their residents, or people want to offer ride hailing like Lyft and Uber. But everyone has limited budgets, so they're looking for a way to provide us. They're looking at ways to use the assets better, looking at ways to provide us, more technology that people are used to. And that's where you need a mobility software platform. So Spare it's benefited from growth of non-metropolitan areas, growth of stretched government budgets, and the rise of ride sharing and last mile delivery because they're enabling that. And finally, this is one reason people want to see shared mobility increase is it's part of climate change, fighting climate change, get less cars on the road, let's get more people in vehicles. So there's a few different trends that they seem to be benefiting from. The other one, so the other two things, it has a lot of tractions with 80 customers in Canada, United States, Europe, and Japan, and it's starting to show network effects in the geographic areas it's in. So they get into, let's say, let's again, I don't know if Innisfil's a client.
Like
They
from
start
town to town, like the
from
neighboring.
town to town, and provider to provider in a town. So they might get the government, then some, then some then some private sector customer wants to use them, and then the adjacent community wants to use them. So they're starting to see network effects where they get like an anchor customer, and then they then get like 7 or 8 customers, both private and government and non-government clients. So it's very interesting because there's a benefit because they can share assets, they can share demand, they can share supply. So a bunch of non-related, it almost creates a marketplace on top of their operating system.
Interesting. So that's exciting for them. Anything else you wanted to share about this round?
Uh, just say, hey, corporations investing not only at JL in this one, the previous round was all Mitsubishi Corporation. So
Is
seems
there a Japanese connection here that we're missing? What's going on here?
well, if you go look at their customers, they have a lot of penetration in Japan.
Got
So
it.
lots of towns in Japan
And they got the good folks at Ramen Ventures in as well. So they're really doubling down on their Japanese
oh,
culture.
yeah, I guess you can argue. Oh, Adam, I don't, loves Japan, but I'd say he's more Shopify connection than Japan connection.
And if you're an early stage entrepreneur in Canada, what are you learning from this particular raise?
Well, I think if you look at their history, and we didn't get into this, the company pivoted from being a provider of transportation systems. So they were trying to actually be one of these like ride sharing platforms themselves and saw demand for the operating system. And they basically followed what attraction was and built the mobile operating system. So listen, pay attention to what's going on in your customer with your startup and seeing where demand is. And sometimes a pivot is not because you're desperate, but because you see an opportunity. Second of all, network effects for enterprise companies that serve enterprise seem to take longer to merge. Spare starts showing network effects when they in municipalities. I don't think they knew it was going to happen, but they saw this opportunity and are now doubling down on that. Last week, about a month ago, we talked about Rose Rocket, who the network effects took a while to come out. So consumer network effects are obvious. I think enterprise network effects are more subtle, and you should, if you start to believe they're there, you should try to encourage them, but be patient. And finally, Canadians, we usually look south for our customers, especially enterprise customers. But we're in Canada. We're connected to the world. Everyone loves us. You can look globally, and like you see this 80 customers, and a lot of them are outside of North America, including some deep penetration in Japan. Just encourage the founders out there and the teams out there. Don't think South, or maybe you want to think Latin America, but don't think of US to start with. They don't have to be your first set of customers.
I love it. Think international. Wait for those corporate network effects, and of course, that first one, my favorite one, but I forget it now. What was it?
Come join TechTO and be a
Oh
participant in
yeah.
TechTO.
No, it's the pivot. That pivot was amazing.
Oh,
You got
the
to make
pivot.
those pivots,
Yeah.
listening to your customers and going where the demand is. But you do got to join TechTO if you want to join a community of Canadian tech founders, entrepreneurs, investors. Head on over to techto.org and sign up for that insider membership program. Alex and I are there every day answering questions, making connections, and helping you pivot. Alex, who have you helped pivot in the insider community recently?
An insider community? Well, I know some insiders that have pivoted.
I'll take it.
Trilock pivoted from the Hooter customers to a different type of customer.
Mm-hmm.
So they went from like serving small businesses that had international clients to small businesses that are distributed, different type of customer. So there's big pivots and there's small pivots.
I love it. Last up for today, the end of the road for Roadmunk. What happened here?
So Roadmunk was acquired by Tempo Software out of Boston. Tempo is a team management and productivity SaaS software. Roadmunk is a platform that allowed organizations to collaborate on their product roadmap. Seems like a natural fit. The exit was announced this week.
Do you have any details on the size of the exit?
No, wasn't. No details. Usually, when there's no details, it means it was a nice exit at best, not a spectacular one. My assumption here is Roadmunk was a hot startup in the ecosystem at one point, and they had an exit which people did okay by, but not going and buying houses in expensive houses in Vancouver or Montreal or Toronto.
Oh yeah, must be nice. So what does it mean to be a hot startup?
Well, I think it's one that has buzz and gets everyone excited. The Roadmunk was a Waterloo-based company. They raised 1.5 million from Garage, Golden Ventures, and Felicis when that was a significant amount to raise in your seed round. And there was a lot of buzz. They'd be like, "Oh, who's up and coming company?" They were featured in lots of hot lists, and it just one where people want to go work for, and it seems to be going to the moon.
And I guess this is maybe a cautionary tale.
Yeah, I think. Look, I think we celebrate each raise, and we anoint winners early on, and I think there's two things that can happen. There's three things that happen, and you should be aware all three can happen. One is the story's true, the hype's real, and they build a company that goes to the moon. What's more likely to happen is you build a good but not a spectacular company, and everyone does okay, but not really well, and especially real estate, sometimes it just doesn't work out. So I think and I'm going to put this now as a founder here. Well, first founder, don't buy the hype. You've never made it until you've exited the company. So even if when you go public, you still have to keep them performing. And I think for employees that get excited, or potential employees that get excited by these announcements, you have to do due diligence to understand what you're going to get out of the company, and if you're okay with the variability of outcomes, and make the judgment of, is this a team I want to work for? Is this an area I'm excited about? Am I going to get enough outside of beyond my immediate returns? Because options can make you rich, or RSUs can make you rich. They're hard to depend on an early stage. You should think of them upside, but you shouldn't be, expecting them to fund your kids' college tuition.
So that's interesting advice for maybe people looking to join a startup here in Canada. If you're a founder and you find yourself in a hot startup today, what do you think you should do to manage it properly?
Well, just ignore all the hype, be paranoid, and focus on making sure you're actually building a company that serves customers' needs and you can make money on it, and you understand how, and you always understand how you're going to get there and what you need to get there.
I love it. Got to stay paranoid out there if you're going to survive. Thank you, Alex. What a week in Canadian tech. If you haven't already, you got to like and subscribe to TechTO wherever you're watching or listening, and we're going to see you on the inside.
We're in the business of delivering impossible things. We're in the business of delivering things that nobody's ever seen before.
If you build that culture, you'll come up with really cool and innovative stuff, and literally could be in the next multi-billion-dollar idea.
So this conversation is largely going to be about scaling yourself and scaling your leadership team.
I want to talk about one of the biggest struggles that I think a lot of startups face early on, which is building initial traction.